Welcome to Value Added, the real estate podcast where we speak with the brightest minds in the world of real estate who provide, create, and realize value in an ever-changing market. If you're a real estate professional delivering value to your clients, an investor creating value not seen by others, or a busy professional who passively invests in real estate to grow the value of their hard-earned dollar, then you're in the right place. And now your host, Nick Walters.
Hey gang, welcome to another episode of Value Added, the real estate podcast. On this week's episode, we're chatting with Dylan Marma. Dylan is the founder of Cirrus Capital, a Knoxville, Tennessee-based investment firm. Cirrus Capital provides investment opportunities for qualified investors in the commercial real estate market, specifically in the multifamily asset class. So without further ado, let's get on with the show. Dylan Marma, welcome to the program. Good to have you.
Thanks for having me, Nick. Excited to be here.
Tell the listeners a little bit more about you and how you got to where you are today.
Relatively young as far as my career goes, 26 years old. I've been investing in real estate for the last 5 years now. I had a story where I was growing up, always expecting to go sort of the traditional route. I grew up in upstate New York, so naturally the thing to do was go and start working towards getting your accounting degree and getting into finance. And that's the path that I thought I was going to go. And I had a bit of a wake-up call halfway through college where I really began to deep dive into a lot of these entrepreneurship and personal growth books and explore other avenues of getting out there and creating wealth. And I really just became enamored with the idea of being a real estate investor, being an entrepreneur. And when you're 19 years old, finishing up school and going that route feels like such a long haul. So I was so eager to get out there. I left halfway through school, moved out to California with the intention of getting into real estate investing, started working a W-2 job for a real estate investing company out there, spent 3 years with them, saving up my extra cash to buy my first single family property, then a duplex, started to learn the ins and outs on how investing works. And soon enough, I really took a look at multifamily and I saw the economies of scale that are presented with multifamily and also the ability to scale a true business with the model of syndication. So I really started to dedicate all my time and effort towards the business of syndication. And for the last 3 years now, I've been full-time in multifamily. I've moved out here to the Southeast where I'm currently based. I've worked on 50 million in total projects through Tennessee, Kentucky, West Virginia. The first deal was in upstate New York, actually, funny enough. And all in all, it's been a great run. Worked on JVs, general partner on syndications, and really just gotten a lot of experience in a pretty short period of time.
What was the hardest part for you transitioning from a W-2 position to getting out there on your own?
I think number one, I took a riskier bet than I would encourage for most people to do. I don't say for me to follow that same path, but I was in a position where I felt my backup was against the wall in terms of accomplishing my goals. I had been working 65, 70 hours a week. So it's not like I had time to go and travel to check out and be boots on the ground in the market. So I couldn't be boots on the ground. I didn't really have the time to be as active as I'd like to be. I didn't really have the money because when you get into multifamily, you'll never feel more broke than anything else because you're dealing with such a capital intensive business. So I didn't really have enough to make a real dent playing from afar in that sense. So I lived in San Diego and there's no deals out there. So I got to a point where I said, listen, I'm convinced I have to go free up some of my time, take the leap of faith and see what happens. So I move out to Atlanta, start to, build the relationships, build contacts throughout the Southeast, see where that leads, and worst case scenario, I'm, at the time young, I still don't have, kids and wasn't married. So, I had the ability to take that sort of bet on myself. I think psychologically, just leaving W-2 and watching your money in your bank account go down every week rather than go up or even stay flat, it does play a little bit of an effect, right? And also when you go into entrepreneurship, it's just never as clear as it is with the W-2, right? And I think that's for me part of what attracted me to it. But you have to be okay with that, right? Because there's no one right answer, one way of doing things. You really have to blaze your own trail and create your own path and figure things out by testing and trying and, experimenting and just, really being disciplined with your overall ability to manage yourself.
Trailblazing, you say. Exciting, scary, or all the above?
That's definitely all the above. I'd say it's like anything else, right? It's like you're on a roller coaster and you have that feeling in your stomach, right? Where it's going to be exciting, it's going to be a little bit scary all at the same time, and that's sometimes where you put yourself. I don't think you have to go in over your head. I think everyone has a certain level of comfort that it's not like taking the most risk is always going to get you the best results. If you take not uncalculated risks, you could end up in a pretty bad spot overall, right? I think calculated risks is really what it's all about. And you have to factor in your life circumstances, you have to factor in the asset class you're looking at, right? You have to factor in what type of deals you're looking for. And just, so it really parallels really nicely in terms of, both the way you look at deals when you're evaluating risks and the way you make life decisions, evaluating the risk and the opportunity and trying to find something that you can live with the worst case scenario, we'll say.
As a real estate investor in your mid-20s, what has been the hardest part of the real estate syndication business, raising capital from private investors?
When it comes to raising capital from private investors, I think you really need to, first I'll touch on the age thing, right? Because some people might have questions on that, right? Of, if I'm in my 20s, how am I going to be credible and have that kind of background? And that can be a limiting belief for some. So just to touch on that, number one, it comes from really, really knowing your stuff, right? And I felt before I had done my first deal, I was talking to people that had done several deals already, and I felt like I was ahead of them in terms of my base level of education. And I'm not saying that to toot my own horn, but I'm saying just I was aggressively diving into every book I could get my hands on, aggressively talking to everyone I could, asking all the questions, never being afraid of looking stupid when I didn't know things. And I think that having that base gave me personally the confidence that I needed to be able to talk to people, because I knew the numbers, I knew what I was looking at, and there wasn't that part of me that was just afraid of getting asked a certain question, because I felt I could hold my own in any conversation about the space. So I think it all starts with a foundation for education. That's probably not an age thing, but it definitely helps if you're already a little bit conscious of what people are thinking about you for being younger, right? Now, when it comes to the latter two, whether you're new to real estate or whether you're young in general, I'd say most people are faced against this whole thing where they're uncomfortable talking about raising money for their first deal because you don't have credibility yet. You kind of go through like a little bit of a first deal syndrome where you're just not really so confident, and you don't really want to raise money yet, right? But you need the money first, right? More than anything, I always recommend having the money lined up before you go find the deal, because that's going to give you the confidence and the certainty you need in the first place to go and find the deal and put the time and the effort in. But to do that, I really encourage working with partners. I really do, because it doesn't have to be just your first deal. You can work with people that have experience in the business, partner with them, even if you're not going to make as much profit. It's not about how much money you make on your first deal or second deal. It's about how much experience are you gathering. So if you can bring someone in that has experience and know that they're going to be looking over your shoulder and guiding you along the way, when you approach investors, the conversation completely changes. It's not about, oh, this is my first deal, I really think I have what it takes, give me a shot. It's about, I'm partnering with this group of experienced investors. They've done this many deals before, and together we're gonna make this thing a great success, right? So just the way that story flows is going to be a lot better. So I would encourage, even if you found a deal and you're ready to raise the money, you're ready to do everything else, still bringing someone in on that first or second one, just so that you have someone else to work with that's been there and that has experience. Because I think as an investor, if you're a passive investor, you're really doing them a service by bringing in experience to manage the oversight of both the due diligence and the asset management.
let's walk through a deal that you uncovered significant value.
I have one that comes to mind, I think will provide a lot of value to all listeners and really give a perfect example of what that first deal, or maybe it's what the first larger deal in my case looks like, and the feeling you have when that first hits. Now, just to note, I have yet to sell any of the multifamily deals that I've picked up. So we have yet to realize the value, but we can be pretty sure of where they are today, right? Now, in this deal, this is an instance where we did a 132 unit deal up in Kentucky, right? Is in Louisville, Kentucky. This was I believe our third trip out to the market. And I always encourage everyone to go and actually get out there in the market, even if you don't have the perfect deal lined up. Just make trips, start showing face, let it be known that you're eager to get into the market, because that's how you're really going to get to know the brokers. That's how you're going to build trust. And that's how you're going to get to see more deals ultimately. Now, we had went out there and drove 3 properties so far that day, and from what we saw, they did not look like they did in the pictures. There was one that was drug infested. One of them was just an old building that had a ton of capex nightmares waiting to happen, and the other one just was a no-go as well, just based on just location. And not saying there's no opportunity in those kind of deals, but in this case there wasn't for the price that we're looking at. And then we got wind of another off-market deal, and at this point we were almost just discouraged as a whole, because we've been beat up so much throughout the day. But we said, let's go check it out, right? Let's see what can happen. And obviously, we're never going to say no to seeing the next deal. So we went out and we drove the last deal of the day, and we got on the property, and it almost felt like the skies opened up and the sun started coming out and things just looked rosy again. Because we saw right away, this is a 1980s built, which is a good year, I think, for a lot of us value add guys. It's kind of less CapEx headaches with the 1980s build, but there's still significant upside. We saw that the exteriors had not really been updated at all since then. The parking lots had not been done over. And then coming to get to know the way that they were operating the property in terms of their income and expenses, we got to know that it was a couple that had inherited the property. There was no rubs being taken place. The average rents were $530. Keep in mind, the rest of the market was doing about $720 in rents. The interiors had the old tan stoves, and they had, in some cases, even the old retro green carpet on the floor, right? So there was no true upgrades getting done throughout the interiors of the property, but it had really good bones, and the area was a really solid, just suburb, local suburb in the area. So we went into the property. Well, first off, we got the price, right? And the second we got the price, looked at our numbers and we agreed to it. We did not negotiate, right? This is, at least, my philosophy is that, if the price makes sense, so there's no need to go and try to take more off, right? We don't negotiate for the sake of negotiating. We negotiate because we need to hit our returns, right? So made sense. Gave them the same exact price, gave them 24 hours to respond to the LOI, because we knew, it just made enough sense with the amount of upside there. And we were in at a great basis. We expected it to be worth well more than that at sale. So we went in, we took over the property, and let's think about the ways we added value. Number one, there was 4 acres of land. So before we closed on it, we used agency debt on the property, lower leverage debt, because it was our first one in this market. But we were able to get in and split off a land parcel to its own separate LLC. We sold that land off for, I think it was over 100,000 or so. It was 125,000, which just a nice cherry on top, right? That wasn't making the deal, but it was a nice move that we otherwise wouldn't have had that extra money to show for. We also leased up. There was, next to the leasing office, there was 2 commercial units that were basically just like giant garages. So we cleaned out all the junk that was sitting in those, and we started to lease those out to different local vendors in the area. I think one's an electric company, the other one might be a plumber or something like that, right? But we found another way to create additional income. So first off, we're maximizing all the extra space there. We're taking advantage of this big garage. We're getting rid of the extra land, right? So making sure we're maximizing the space. Then from there, I always like to call it the 90-day plan, those initial action items when you take over the property. Right away, change the signage, right? We're going to rebrand the property. We're going to go out there and resurface the parking lots as needed resurfacing right away. And we set up a dog park. We set up a gazebo with a grill, and then we set up a dog park with another piece of that extra land that was still on our property. So we maximized the space, and we made a really good dent to, just showing people that we're here to add value, right? We're not here to just increase the rents, right? Naturally, we are going to bring these rents to market, right? And that's obviously a big part of our business plan. But somehow amidst this, we were able to bring the rents up, kind of staggering it, right? Because you want to avoid the mass exodus where everyone moves out all at once because you just go up $200. That's just not our business plan. We wanted to kind of do a little bit more gradually, where we go from 520 to, low 600s, and then we test it out to the higher 600s. And now finally, after 18 months or so, we're getting to the low 700s. So we're kind of gradually creeping that up and keeping the occupancy north of 90% along the way. The best we can. And we actually were managing to get good positive reviews from the residents, even though they're starting to go up in rent. They're giving positive reviews because we're handling problems that were not being handled by the previous landlords, and they were great people. They just were kind of burnt out, right? And they just were not doing giving it the same attention, right? So now we're handling all the deferred maintenance problems that had been taking place. We're starting to make the place look nicer. We're starting to build more of a community look and feel to the project. And we even started to paint the exteriors. We didn't paint all the exteriors. We painted about half the exteriors so that the next owner can finish the job in terms of that. But we painted all the exteriors that are roadside. So we just made it much more attractive from a curb appeal standpoint. And made it much more modern looking, and the residents just responded in kind. They were very, very happy about that. And I believe the income, gross income on a monthly basis went from, I want to say it was 60,000 or so to over 90,000 or so by the end of that first 12 months, which was pretty insane, right? I wouldn't underwrite to that. It actually, by 12 months in, we were actually doing better than I initially projected we'd be doing by the end of our second year. So that was definitely just a great project overall. And it's one of those things where I had looked at hundreds of properties. I don't know the exact number, but I'm sure it was well over 100 properties before this one came up, and it almost felt too good to be true when everything started to make sense. We just kind of were scratching our heads saying, that's the price, that, this is the upside. Are these really what the comps are getting? Driving through the comps, we're kind of verifying everything. And it really does feel too good to be true sometimes when the deal comes up. I mean, I'm sure there are deals that are too good to be true, and there's other problems that you're not seeing, but just know that, a lot of times you can be discouraged when you're looking at a lot of deals and things are tough, right? It's been a tight market lately, but that is, there are deals out there, and it just takes persistence to go through and pull through. So yeah, I think on that deal, I mean, I talked about the gross income, but as far as the returns, I know we projected a 15 investor IRR, roughly 20% total deal IRR, I believe, and I know we're well ahead of schedule on that one. So we'll see where the exit pans out, but it'll be well above that.
That IRR is based on what, a 5-year hold?
That's correct. Yeah, 5-year hold, right? And we actually we're probably going to sell before COVID, just because we've been doing so great. But we had long-term debt on it, so we're not really. We're going to be patient at this point and just wait until the market's warm enough for us to go back there. I think we should clear. If we were in at mid 40s per unit, we expect to be well over. We'll say hopefully 20,000 more per unit on the property, just depending on how the market plays out.
It's really fantastic to see in your transition period of increasing the effective monthly rent 30% from, you said, 60 grand a month to approximately 90 grand a month. Not only increasing rent collections, but you're also getting positive reviews from the tenants. You're adding significant value into their quality of life.
Yep. And I think the way that you do that is have a really regimented 90-day plan as far as your takeover plan, and make it value for value. So go out there and implement your 90-day plan, put it to work, start upgrading the signage, upgrading the lighting, doing all the exterior stuff. because you're not going to go in the middle of where someone lives and put new flooring in, right? You're not going to be able to get to the interior stuff until usually they move out, or there's some kind of circumstance with a turn, or they switch units or something like that, right? So oftentimes you want to start with the exterior stuff because that affects everyone, and it really makes a nice impression early on.
We haven't touched on the rebranding that you did on this particular deal. Did it change the overall perception of the asset within the community? And did the rebrand attract a different tenant into the rent roll?
So in this case, the name was just a name from back in the 80s, and it just, I think, sounded like it was a little bit aged at this point. So I think with us rebranding it, it mattered less about the name and more about just the fact that we were rebranding it, right? And sometimes some places carry a bad stigma, so you're really trying to heavily rebrand that, and it takes a lot. In this case, it was just an old name, and it was just, ownership just had not done much to the property in a long time. So I think it just made it very clear that with the new signage, with the new name, with the new management company, with all the exterior work getting done, it just showed clearly that things are going to get better here, right? And that's the message we want to get across, is that this place is going to get better. We're here to improve your lives. We're here to create a create and that's what we represent, and that was our intention. And almost always, we would probably rebrand a property. I mean, there's some cases that you wouldn't need to, but we're buying value add assets. So if you're trying to explain the value you're going to be adding, I think it's just better to start fresh and start new versus trying to just take a name and shift the perception on it.
At the time of this recording, we're a couple months into the coronavirus quarantine. How are you underwriting deals now? And how is that underwriting different from 90 days ago when you were underwriting deals?
So 90 days ago when I was underwriting deals, I think it was a little bit more clear in terms of what I wanted to hit with a target return for investors and for the deal itself, right? I think I had kind of the baseline that was probably pretty similar to what a lot of other people do, with probably just different assumptions and things like that. But things have definitely changed a lot. I have friends that have all differences in opinions. I think all of us can agree, though, that we think pricing is going to go down more still at this point in time, right? We think there's going to be a dip. It's just how much of a dip and how long until that dip occurs, and how long does it last for, right? That's really where I speaking to industry veterans, that's where we stand. Now, as far as my underwriting, I'm still of the mindset that there are still deals out there. What those deals look like is subjective, but it always is. I would say for me, in my case, I'm putting more weight on the actuals in terms of the financials that are coming in. I'm putting less weight on any market appreciation, and I'm putting a little bit less weight on any forced appreciation in terms of being able, and the time it's going to take. I'm extending the time it's going to take to be able to creep rents that are below market up to what we would consider the market. So I'm just shifting the amount of weight I'm putting on the different factors of where the value gets added, because you have in-place value if you buy at a good basis, and that I'm paying a lot of attention to. Anything I'm looking at, I'm hoping that we're in at a basis that is lower than any of the sales comps over the last 2 years, assuming it's a real value add deal. I also want to see that there's been comps that have already traded at around what I would like this deal to trade at once the value is created in the deal, right? So just looking a lot more at the basis currently, what the in-place numbers are like, being more conservative in terms of the creeping rents up to market, and more conservative in terms of the future growth, as far as markets. And to be honest, I'm just looking for better returns. I'm just more than anything, making sure that the deal is going to result in a better investor return than a deal would in a standard market, and better overall deal return. So I guess those are the big things in a summary that I can basically put into a nutshell. But it's just making sure that the deal makes a lot of sense, that your downside's relatively low and the upside's higher than it would typically be, because you're willing to take the risk and move during a time where a lot of other people are sitting on the sidelines.
The current deals that you have under your control, how have the collections been in the last 60 days? We've heard multiple reports that collections overall have been not hit as hard as expected. How are you seeing it out there with your portfolio?
No, that's definitely been the case for us. I would say that a lot of the previous deals we've done are C-class 1970s built properties. So the C-class will get hit a little bit harder than the B-class will, but on average, we're even on our properties that we've done worse on, we're still less than 10% behind where we would be on a typical month, and it hasn't put us in any point of discomfort as far as being able to, or I guess it hasn't raised any red flags, we'll say. It's obviously not ideal, but it's not danger zone by any means. So we are pretty happy with how things have been getting put together. And I think that's been a result of being very proactive on the management side and making sure we're very actively managing the residents and setting expectations up front. I have found that the deals that I have that are a little bit newer, or even sometimes the smaller deals, so deals that are less than 100 units, I've found those have held better occupancy across the board, and in some cases has not been phased at all. But the C-class stuff is naturally going to be a little bit more variable because it's more of a balance sheet issue, right? And people run out of savings on lower income properties.
We're going to close out this interview with the hard-hitting questions. These are the questions that we ask every one of our guests. First off, what is your why?
So my why is just the fact that I love building things and I love watching things come to life. More than anything, I get excited, less about just doing a deal, but really about building an organization long-term, building systems, and just building something that's here to last, and just working towards being the best version of myself and of an organization that we can be.
Besides your alarm clock, what gets you out of bed every morning?
At this point, I don't use an alarm clock. So at this point, I just get out of bed and focus on learning first thing in the morning. I'd say more than anything, I love learning. I love reading, love listening to podcasts like this, right? Anything I can do to just absorb as much information as possible and get a little bit smarter every day is what keeps me juiced up.
On that note, can you recall a book that you've recently read that has impacted you significantly?
So recently, in addition to real estate, I've actually been working with a couple partners to launch a real estate technology and software platform. And one of the big technology books that most people in the space have read or heard of, at least, is The Lean Startup. And I highly encourage anyone to pick that book up, even if you have no intentions of ever being in technology. It's not just about that. It's about innovation and the way it works in general. And it's totally even shifted the way I view the way we do value add real estate deals, because a lot of people want to go in with this cookie cutter business plan and project where they're going to be to the penny in the next 5 years and have an IRR that goes to the second decimal point. And the reality is, these are just forecasts, right? And we need more than anything to remain flexible and be able to pivot along the way with our business plans. Oh, people aren't really paying extra for the stainless steel appliances. Okay, let's hold back. Let's hold back that capital. Let's start doing different types of upgrades, right? And being able to pivot on your business plan, I think, and adjust to what the market's giving you, I think is such a valuable learning lesson for me, and a big shift in the way I look at things.
How do you like to blow off steam?
Really, for me, it's exercise and meditation. I'd say those two things keep me cool, right? Because we're most of us are working long hours, long days, and I'd say just the two things that keep me sane outside of the reading is meditating at least 20 minutes a day, and then exercising.
How can our listeners get a hold of you or learn a little bit more about you?
You can reach out to me. My email, dylanmarma@gmail.com. You can check out cirruscapital.com if you want to visit the site. On most major social media platforms, so should be easy to access.
Dylan Marma, that's a wrap. Thanks so much for adding your value today.
Thanks for having me.
Thanks for listening. If you enjoyed this episode, please make sure to leave a rating and a review, which will help us introduce the podcast to other listeners. Also, don't forget to subscribe to our YouTube channel, which will give you access to other episodes you may have missed. Have a great day, and we'll talk to you next week.